Everyone seems to think that AI is a bubble at the moment. Alongside the usual chorus of doommongers, CEOs like Sam Altman, Jeff Bezos, and Mark Zuckerberg have all admitted, to varying degrees, that AI is looking a bit bubbly, despite the fact that they have an incentive not to. Even hallowed institutions like the IMF and Bank of England, who usually stay out of this sort of thing, are now sounding the alarm. So in this video, we thought we'd explain why AI looks like a bubble, and why it probably represents a bigger threat to the wider US economy than you might assume. Don't miss an episode, and always feel in the loop by subscribing and ringing the bell. Now, there are two big reasons that people think that AI looks like a bit of a bubble. The first is the mismatch between the money that companies are investing in AI versus the money that AI is actually making. In 2025, companies in the US are expected to spend roughly $400 billion on data centers for AI alone, and hundreds of billions more in the coming years. Analysts at Morgan Stanley reckon that $2.9 trillion will be spent on data centers and related infrastructure by the end of 2028, while McKinsey puts it at an eye-watering $6.7 trillion by 2030. Of course, big numbers aren't bad in and of themselves, but the problem is that all of this money is being invested into a technology that doesn't yet generate much revenue. The Economist, for instance, estimates that AI-related revenues will total $50 billion in 2025. That means that this year, the amount being invested in AI is 7 or 8 times the amount that the technology actually generates. To compare to previous bubbles, the investment revenue ratio for telecom companies during the fiber optic bubble was about 4x, and about 2x for rail companies during the railway bubble in the 19th century. This implies that for these massive investments to pay off, AI revenues will have to increase insanely quickly over the coming years. So that's the first reason that people think AI looks a bit bubbly: the big gap between investment and revenue. The second reason, though, is dodgy financing. The case that's drawn most attention was a deal in late September between Nvidia and OpenAI, whereby Nvidia agreed to invest up to $100 billion in OpenAI to fund more data centers. And OpenAI pledged to purchase millions of Nvidia chips for those same data centers. This looks suspiciously circular, as if Nvidia and OpenAI are just passing money between themselves to inflate their revenues. But this is far from the only case. In fact, as this helpful/scary graphic from Bloomberg nicely illustrates, Nvidia actually has similarly incestuous relationships with most big AI companies. Nvidia's defenders might argue that this is just a form of vertical integration, no different from when, say, Volkswagen takes a stake in a company in its supply chain, which happens all the time. But there are other eyebrow-raising AI finance stories out there. For starters, some of the valuations are mind-blowing. Mira Murati's new AI company, for instance, just raised the largest seed round in history at a $10 billion valuation, despite the fact that the company hasn't released a product and refused to tell investors what they're even trying to build. Even well-established tech companies, which previously funded their investments with cash on hand, have resorted to borrowing enormous sums of money and using accounting tricks to depress their reported spending. Companies like Meta and Microsoft, for instance, are tapping private finance companies and using weird things like special purpose vehicles, which essentially allow companies to borrow without having to actually show it on their books, in order to fund their data center build-outs. This all looks pretty dodgy, especially because companies like Meta and Microsoft could easily borrow the money by just issuing bonds. You get the idea then. The revenue investment gap and this funky financing have sparked some anxiety that we might be in one big AI bubble. This is obviously a risk for anyone in the industry, or anyone with money in AI stocks, but perhaps most worryingly, it also looks like a systemic risk to the entire US economy. This is because AI is apparently keeping 2 of the 4 components of US GDP, investment and consumption, in the green. Most of the recent growth in investment has come directly from AI-related spending, which alone now accounts for something like 40% of all US GDP growth. Moreover, there's good reason to think that the AI boom is keeping consumption afloat too. This is because the AI boom has caused a stock market boom, with AI or AI-adjacent companies accounting for 80% of the S&P 500 gains this year. And it looks like this stock market boom has encouraged rich Americans, who are more likely to own stocks, to continue spending their money, which has in turn kept consumption in the green. For context, the US economy is more reliant than ever on rich consumers, and the top 10% of earners now account for an unprecedented 50% of all spending. This explains why consumer confidence is down to 2008 levels, but consumption keeps coming in above expectations. Your average American is paring back their spending, but rich Americans are splurging. If the AI bubble were to pop and stocks were to crash, this would cause rich Americans to pare back their spending too, pushing consumption into the red. More generally, an unprecedented 30% of America's net household wealth is currently tied up in stocks, making the overall economy more exposed than ever. You get the idea. Directly and indirectly, the health of the US economy is remarkably dependent on AI, which means that if AI is a bubble and that bubble pops, it would probably bring the US down with it. Given the central role that the US plays in the global economy and the fact that foreigners have invested unprecedented amounts into American stocks, the rest of the world probably wouldn't be much better off. And there are also reasons to think that the US would be more affected than usual. In previous crises, the US has benefited from its status as the world's safe haven, which has in turn allowed the US government to borrow massive amounts of money and spend its way out of a slump. It's not clear that the US could use the same strategy today, though, both because its status as a safe haven has been tarnished and because it lacks fiscal space. As a final thing, people like Jeff Bezos and Sam Altman have argued that even if AI is a bit of a bubble, it's a good bubble, because like the railways built in the railway bubbles or the fiber optic cables laid during the telecoms bubble, these data centers will eventually get used. Well, maybe, but it's worth noting that data centers are disanalogous in one key respect. Unlike railway and fiber optic cables, the chips in these data centers, which account for something like 60% of the overall cost, depreciate relatively quickly. This means that unless the industry recovers quickly from any crash, investors will be sitting on a pile of old chips that are being made redundant by new ones. Before you go, we've just announced our new coffee table book, Assembly Required, a 300-page book which highlights 27 of the world's most beautiful parliament buildings, from the classics like the British Parliament in Westminster, to the US Capitol or the Hungarian Parliament, to ones you might not expect, like New Zealand, Bhutan or Bangladesh. For each parliament, we don't just show beautiful photos of these actually incredible buildings, we also tell you the stories behind the buildings, both through passages written by our team, as well as through detailed custom-designed floor plans and diagrams. We really did spend a long time on this too. We spent ages digging into the stories of parliament buildings all around the world, before narrowing it down to just the most interesting and beautiful buildings, writing tens of thousands of words to tell you their stories. We've also made both desk and wall calendars based on Assembly Required too, allowing you to experience these beautiful buildings year-round. Both are also double-sided, providing tons of bonus images for you to enjoy. If you're interested, you can click the link in the description to find out more. Plus, there's a whole load of bundles available if you want a good deal. Plus, if you do want a copy, then you can get 15% off anything Assembly Required by using the code ASSEMBLY. That code only lasts for this week, so if you're interested, now's your time. Anyway, this is just another way that you can help fund our journalism. So if you are interested, then your support will help us to continue investing in our journalism, as well as providing free content for years to come. So as always, thank you very much.